Imagine sitting at your solid oak kitchen table on a crisp Tuesday morning. You just poured 2 glasses of expensive champagne. You are holding a crisp manila folder in your hands containing the final payoff notice for your 30-year mortgage. Your spouse is smiling across from you. You look down at your leather portfolio containing your latest quarterly financial statements. It shows a balance of $1,200,000 across your employer-sponsored accounts. You believe you have won the game. You believe you have crossed the finish line safely. You think your reward for 40 years of sacrifice is absolute security. But I am here to tell you that what your estate attorney did not tell you, what your human resources department intentionally hid from you, and what the financial institution managing your money will never admit to your face, is that you are sitting on a ticking financial landmine. You have walked directly into a trap designed by the federal government to confiscate up to half of everything you saved. I call this trap the tax-deferred mirage. It is a structural mechanism embedded within the federal tax code that transforms your hard-earned wealth into an unsecured liability for the Internal Revenue Service. Over the next few minutes, I am going to break this wide open. I am going to teach you the exact federal codes, the hidden statutory limits, and the 7 critical structural errors that are actively dismantling your retirement security right now. Before we dive into the raw data, smash the like button right now. Do not do it for me. Do it because the corporate algorithms actively bury this information. The Internal Revenue Service is perfectly happy when these rules remain completely invisible to the public. The financial institutions that collect massive management fees on your assets want you to remain completely asleep until it is far too late to change course. By clicking that button, you are forcing this warning into the feeds of thousands of other hardworking people who are currently being lied to about their financial future. This is a matter of informational survival. Let us look at a case study that demonstrates exactly how this mechanism destroys real lives. Consider Thomas and Margaret, a couple living in Tucson, Arizona. Thomas spent 38 years as an industrial plant manager. Margaret worked for nearly 3 decades as a senior school administrator. They are exactly 64 years old. They own a beautiful home valued at $625,000, and they successfully accumulated $1,420,500 inside their traditional tax-deferred accounts. They believed they were completely safe. Then the trap was triggered. It did not happen because of a massive stock market crash. It happened because of a routine series of life events. Their home required a complete roof replacement costing $35,000, and they decided to finally book a long-delayed dream retirement trip to Italy, costing $15,000. To fund these expenses, they authorized a direct cash withdrawal of $50,000 from Thomas's primary account. They assumed they would simply owe a standard manageable amount of income tax on that $50,000. They had absolutely no idea that this single action would set off a catastrophic cascading failure across their entire financial ecosystem. Subscribe to this channel right now because your financial survival depends entirely on understanding the predatory mechanics of the system that wants to claim your wealth. When Thomas and Margaret pulled that $50,000, they did not just pay standard income tax. That withdrawal artificially inflated their adjusted gross income. This immediate spike triggered the first layer of the trap, which is the provisional income formula governed by Internal Revenue Code Section 86. Provisional income is the specific legal calculation the government uses to determine how much of your Social Security benefits are subject to federal taxation. Because their income crossed the statutory threshold of $44,000 for a married couple, 85% of their combined monthly Social Security checks suddenly became fully taxable. This single $50,000 withdrawal instantly created a brand new $7,000 tax liability on benefits they had already paid into for 40 years. But the destruction did not stop there. The sudden artificial rise in their income pushed them directly over the threshold for the income-related monthly adjustment amount, which is universally known as the Medicare Premium Surcharge Cliff. Because their income spiked, the federal government legally forced both Thomas and Margaret into a higher Medicare bracket. Their monthly Medicare Part B and Part D premiums were instantly increased by over $240 per month per person. That is an additional $5,760 in annualized non-negotiable costs extracted directly from their checking account. A simple $50,000 withdrawal ultimately cost them over $24,000 in combined taxes, clawbacks, and premium surcharges. They lost nearly half of their distribution to a system they did not even know existed. Let me walk you through the 3 layers of this structural nightmare so you can see exactly how the 7 mistakes operate. Layer number 1 is the illusion. The illusion is the widespread cultural belief that tax-deferred accounts are an act of government generosity. You were told for decades that saving money pre-tax was a smart move because you would automatically be in a lower tax bracket when you retired. This is a mathematical lie. When you retire, you lose your structural deductions. Your children are grown, so you lose the child tax credits. Your mortgage is paid off, so you lose the mortgage interest deduction. You are no longer contributing to retirement accounts, so you lose the pre-tax savings deductions. You are not in a lower bracket. You are in a highly exposed position with zero structural protection. Layer number 2 is the mechanism. This is how the system legally extracts your wealth through statutory mandates. The primary weapon used by the state is Internal Revenue Code Section 401 Alpha 9, which dictates the mandatory extraction of your wealth through required minimum distributions. The government does not allow you to leave your money in these accounts indefinitely. The Secure Act 2.0 legally forces you to begin liquidating your tax-deferred accounts when you reach age 73 or 75, depending on your birth year. The government forces this money out into your personal income stream regardless of whether you need it, completely destroying your tax bracket management. Layer number 3 is the solution. Educated individuals do not leave their wealth exposed to these mandatory liquidations. They strategically transition their wealth out of the traditional tax-deferred ecosystem using structural sequencing, bracket optimization, and tax-free asset conversions before the mandatory statutory age limits are reached. Let me run the math so you can see the absolute scale of this risk. Imagine you have a balance of $1,500,000 inside a traditional tax-deferred account at age 73. Under the current Uniform Lifetime Table provided by the Internal Revenue Service, your very first mandatory distribution factor is 26.5. If we divide $1,500,000 by 26.5, your mandatory distribution for that single year is $56,603. If you also receive $35,000 in Social Security and have a modest pension of $20,000, your total adjusted gross income is now $111,603. You are now firmly pushed into the 22% federal tax bracket before you even factor in state income taxes. 10 years later, at age 83, your account balance has continued to grow at a modest 6% compounded annually, making the total balance $1,800,000. However, your distribution factor under the law drops down to 17.7. This means your mandatory distribution for that year spikes to $100,694. Combined with your inflation-adjusted Social Security and pension, your total annual income is now well over $160,000. You have been systematically pushed into the 24% federal tax bracket. Over a 20-year retirement period, this mandatory extraction mechanism will force over $1,200,000 out of your account, resulting in a total lifetime tax bill exceeding $350,000. This is money that could have gone to your children, your grandchildren, or your personal long-term care. Take a deep breath. Listen to me very carefully. You do not have to let the federal government dictate the terms of your financial legacy. You can take complete control of your wealth before these statutory traps trigger. I have developed a comprehensive step-by-step diagnostic tool specifically designed for individuals with over $500,000 in traditional retirement accounts. This tool will analyze your exact age, your specific account balances, your geographic location, and your projected Social Security benefits to show you exactly when your tax time bomb will detonate. Go to your-website.com right now to secure your custom diagnostic report. Do not wait until the next tax year begins, because once a calendar year closes, your legal ability to restructure that year's income is permanently gone. Protect your life savings today by going to your-website.com immediately. Let us break down 3 distinct scenarios based on different geographic locations and income levels to see how these mistakes manifest across the premium nations. Scenario number 1 takes place in California, a high-tax jurisdiction within the United States. Consider an individual with $2,500,000 in a traditional employer account. At age 73, their mandatory distribution is $94,339. Because California treats all retirement distributions as ordinary income with zero preferential treatment, this individual faces a top state marginal tax rate of 9.3% on top of a 22% federal marginal rate. Their combined marginal tax rate is 31.3%. This means nearly 1 out of every $3 forced out of their account is completely vaporized before it ever touches their bank account. Over a 10-year window, this geographic tax exposure costs them an additional $215,000 in pure state taxation compared to a tax-neutral state. Scenario number 2 takes place in Queensland, Australia, involving a self-managed superannuation fund. Many individuals mistakenly believe that once they reach the preservation age and transition into the retirement phase, their wealth is entirely safe. However, if they fail to understand the transfer balance cap, which strictly limits the total amount of capital that can be moved into the tax-free retirement phase, they face severe consequences. If an individual holds $2,200,000 in their accumulation account and fails to strategically manage the excess over the statutory transfer balance cap, that excess wealth remains locked in an environment where earnings are taxed at 15%. over a 15-year retirement timeline. That failure to optimize the transfer balance caps results in over $180,000 in unnecessary institutional compliance costs and asset taxes. Scenario number 3 takes place in Ontario, Canada, focusing on a registered retirement savings plan. An individual age 71 is legally mandated to convert their plan into a registered retirement income fund. If they hold $1 million inside this structure and choose to delay withdrawals until the absolute legal deadline, the mandatory minimum withdrawal rates kick in at 5.28%. This forces $52,800 into their personal income stream. In Canada, this sudden influx of income triggers the Old Age Security Pension Recovery Tax, which is commonly referred to as the Old Age Security Clawback. For every dollar of income earned over the statutory threshold, the government claws back 15 cents of their public pension. This individual effectively faces a hidden 15% tax surcharge on top of their federal and provincial marginal rates, destroying the purchasing power of their public benefits. Let us look at the emotional climax of these mistakes by comparing two families facing the exact same financial reality, but experiencing completely opposite outcomes. Family A is led by Robert and Susan. They did the common thing. They listened to standard institutional advice. They left their $1,300,000 completely untouched inside their traditional tax-deferred accounts, letting it ride in the markets. They proudly told their friends that they were deferring their taxes as long as possible. Robert passed away suddenly at age 74. Under the Secure Act 10-year rule, Susan was forced to navigate the financial transition alone, but the real disaster struck when she passed away 5 years later, leaving the remaining $1,100,000 to their 2 adult children. Because of the elimination of the old lifetime stretch provision, the federal law forced both children to fully liquidate that $1,100,000 within exactly 10 years. Their children were in their peak earning years, already making $100,000 each in their respective careers. This massive inherited distribution forced both children into the top federal tax brackets, instantly consuming 42% of the entire inheritance in combined federal and state income taxes. Robert and Susan's lifetime of hard work resulted in a $462,000 cash payment directly to the Internal Revenue Service. Now look at Family B, led by Arthur and Eleanor. They had the exact same $1,300,000 inside the exact same traditional account structures. However, they chose the educated path. Starting at age 62, they recognized the danger of the changing federal laws. They initiated a series of systematic, multi-year strategic conversions, moving money precisely up to the top ceiling of the 12% and 22% federal marginal tax brackets. They systematically shifted $80,000 every single year out of the traditional tax-deferred ecosystem and into a structurally protected Roth account environment. They paid a modest, controlled tax rate on those conversions using outside cash reserves. When Arthur passed away, Eleanor was completely protected. When Eleanor passed away at age 79, she left a completely tax-free legacy to her children. Because the money resided inside a Roth structure, her children were still bound by the 10-year rule. But every single dollar they withdrew over that 10-year period was 100% exempt from federal and state income taxes. Her children inherited the full $1,300,000 without losing a single penny to government confiscation. The difference between these two families was not their income, their hard work, or their investments. The difference was entirely a matter of structural education. To ensure you do not become like Family A, you must execute these 5 highly specific numbered action steps immediately. Step number 1 is to conduct a comprehensive provisional income audit under Internal Revenue Code Section 86. You must calculate your exact modified adjusted gross income plus 1/2 of your annual Social Security benefits. If this number is trending toward the $34,000 threshold for single filers or the $44,000 threshold for joint filers, you must immediately halt uncoordinated traditional distributions to prevent the 85% taxation of your Social Security benefits. Step number 2 is to initiate a multi-year bracket optimization plan before you reach your statutory required minimum distribution age. You must work with a certified public accountant who specializes in forward-looking tax planning rather than historical compliance. You must calculate the exact dollar amount of headroom remaining in your current marginal tax bracket each year and execute structural conversions right up to that specific limit, systematically draining your tax-exposed accounts while tax rates remain historically low. Step number 3 is to perform a net unrealized appreciation analysis under Internal Revenue Code Section 402I. If you hold highly appreciated company stock inside an employer-sponsored plan, do not blindly roll your entire account into a traditional individual retirement account. If you do, you will permanently convert low-cost capital gains assets into high-cost ordinary income assets. You must isolate the company stock, move it directly to a taxable brokerage account, and pay ordinary income tax only on the original cost basis, while protecting the entire growth layer under preferential long-term capital gains tax rates. Step number 4 is to execute a comprehensive institutional fee audit of every target date fund inside your traditional portfolio. Many seniors blindly trust these funds because they are labeled as safe or conservative. In reality, these funds frequently contain layered internal expense ratios, secondary management fees, and underlying transaction costs that can quietly extract up to 2% of your total account value every single year. You must demand a full disclosure documents package from your custodian and systematically eliminate any asset allocation that charges premium fees for automated index duplication. Step number 5 is to immediately restructure your beneficiary designations to align with the Post-Secure Act legal landscape. Eliminate outdated estate structures that leave traditional tax-deferred assets directly to high-earning adult children. You must update your primary and contingent beneficiary forms to utilize specialized asset routing, ensuring that tax-exposed accounts are directed either to beneficiaries in lower structural tax brackets or to specialized vehicles designed to mitigate the accelerated 10-year liquidation mandate. This script represents educational analysis based on current statutory frameworks and historical financial data. It does not constitute formal legal, tax, or individualized investment advice. Save this video right now. This is not casual entertainment designed to pass the time. This is your personal financial survival manual. Share this video immediately with exactly one person you deeply care about who has worked hard their entire life and cannot afford to lose their savings to structural government traps. Comment below with the exact age you plan to fully transition out of the traditional employment workforce so we can analyze the specific structural challenges facing your generation. Subscribe to this channel right now to ensure you receive our advanced strategic updates the exact moment federal tax codes change. Do not let the system claim what belongs to your family. Take control of your wealth today.